Hello, this is Professor Hazara, and this is the second to last worksheet video in the course. And there's just going to be one example I give you of translation, one example I give you of remeasurement. This is the restatement of financial statements from other foreign currencies, from other currencies. And the final problem I'm going to use is will be on translation, most likely, the bridesmaid fund, because that really is the one that companies use most, and and if you understand translation, remeasurement is not hard, etc., etc. Okay, so I'm gonna go ahead and insert a few rows here. So let's go over so this is translation, and I had some PowerPoints in the last one. I just want to go over the 3 rules of translation. For translation, generally speaking, there's one exception, but we'll get to it. Example. Generally speaking, all accounts are restated at the current exchange rate. That means the exchange rate at the time of the balance sheet date, whatever date you're looking at, the reporting date. Current reporting date. Then a couple more things. It can be called a restatement adjustment, but we call it a translation adjustment. The translation adjustment goes to net income. Okay, so that you're going to have, because you're going to take a bunch of accounts and restate them, you're going to have a plug, so to speak, and that plug goes to, what am I saying? It goes to OCI. Thinking ahead here, it goes to, for translations, OCI, and the translation adjustment, we'll say here, is cumulative, so it's going to be large. For theoretically speaking, this means is that the translation adjustment covers all years from the date you bought the other company, the foreign company, till now. Whereas you'll see that for remeasurement, it just covers the current year. Okay, so let's go through a problem. Here's an example. Okay, so this is in Word. Use the information. Okay. Okay, so there's actually a remeasurement example over here, which I'll go, but I'm going to do that one second, but they're both the same problem, basically. Okay, Kessler Company. We're assuming translation here. Kessler Company, so that would mean that the functional currency of the two companies are different. Okay, Kessler Company, a U.S. firm acquired Aussie Company of Australia on December 31st, 1993, when the exchange rate for the Australian dollar was 49 cents. That would be the historical rate. That would be the non-current rate. Okay, the adjusted trial balances for Aussie Company on December 31, 1994 are provided to the side. It says below, but they're provided to the side. Okay, so this is the trial balance. So I'm going to put a date here. The current date is 12/31 X4. Okay, and so that will be our current exchange rate. Okay, and it says the okay, whatever the exchange rate is there. Okay, on that date. Okay, so it says now. So notice, let's go to the sheet here. So this is the current exchange rate. So this rate right there, that rate right there, that is the current rate. That will be the current rate. Right there, and I'm going to go ahead and emphasize that because that's going to be the rate that we use for most of this example here. I'll see if we can't put that in bold. Okay, so that's the current rate. Okay, because the trial balance for 12/31 X4 and the 12/34 rate there is 58 cents. Okay, I may have to change one little thing here. Okay, Aussie's inventory is comprised entirely of purchases made uniformly throughout the quarter. Last quarter of 19X4, the exchange rate was 53 cents. And keep in mind that current rates can be they can be an absolute rate, the rate that was in existence as of 12/31/24. But if you're looking at things like income which is earned evenly throughout the year, you could actually argue that the current exchange rate that you should apply to income is the average rate for that year. That's what we're going to end up doing. It's still a current rate. Okay, the December 31st inventory of Australian dollars 40,000 was acquired in 19X3. That was the beginning inventory when the exchange rate was 50 cents. Purchases of inventory totaling 52,000 Australian dollars were acquired uniformly throughout 19X4. Remember, we're dealing in 19X4. Okay, dividends were declared and paid on July 30th, 19X4 when the exchange rate was 51 cents. Plant and equipment were acquired in 19X1. The exchange rate was 47 cents, and our exchange rates were as follows. Okay, and I'm going to put here that the average rate, I should actually put this. I'll say this is sort of a new example I'm doing, so you'll have to bear with me. Average rate for X4 was 54 cents. Okay, so let's go through. I'm going to do a few extensions of this rule right here. So I'm going to sort of expand this rule right here and just do a couple of extensions here. Okay, so the current rate, so what we're going to do is all generally assets, okay, on monetary and non-monetary assets. So monetary and non-monetary assets and liabilities, we're going to use the current rate, which is 58 cents. So we're going to have three rates which really matter here. Sales expenses. You're also going to use the current rate for sales and expenses. Since sales expenses are incurred, let's assume evenly throughout the year, you're going to use the average rate for the current year. It's still a type of current rate, but so I'm going to say average rate for the year. I'll say average current rate. And then finally, what I'm going to say is one exception using some form of current rate in translation are equity items. For equity items, which includes common stock and retained earnings, you're going to use the historical rate. So that actually that didn't come out too badly. So for equity items, you're going to use the historic rate. Okay, and I'm going to sort of emphasize that here. It'll come out historical rate. Okay, so I'm going to bold this line here. So really looking at, in general, we're going to be looking at three items. For translation, generally speaking, all accounts restated at the current exchange rate. That's the general rule. Monetary and non-monetary assets and liabilities, current rate. Sales and expenses, the average current rate, because the sales and expenses occur, we'll assume, evenly throughout the year. The equity items, we're going to use historic rate. That's the one, in essence, equity items are the one exception to the rule that you just use the current rate. Okay, so let's go ahead and let's look at what rates we could possibly use here, or major rates. We're going to use basically all the rates here, but what are the three really major rates that we're going to use? We're definitely going to use this one right here, the December current rate there. That's your current, there's your absolute current rate at the end of the year. Then we're going to use the 19X4 average. This is your right here. We'll put here, this is your average. Let's see if we can get this, or whatever, average current rate. And so it's still a current rate for the current year, but it's the average. And it kind of makes sense because these items are incurred evenly throughout the year. And then finally, the historic rate. The historic rate would be 53 cents, I believe. Historic rate would be the rate that existed when you bought the other company, and that is this one right here. This is this 49 cents right there when you bought the other company. Okay, so I'll put in here this one right here is the historical rate. I'll just put a historic rate. So we're going to be using a few more rates, and a few more of these rates, maybe or maybe not. But those are basically, we could call them almost the anchor rates. You know, we're going to use this one, the 58 cents for all assets and liabilities, whether they're monetary, non-monetary, it doesn't matter. We're going to use the 54-cent average current rate for the current year's revenue expenses, which we assume are incurred or earned, whatever, throughout the year. And then we're going to use the historic rate for the equity. So that's 49 cents right there. Okay, so keep those three exchange rates in mind. And the main thing in these examples is identifying the exchange rate. Okay, so cash is a monetary item, and just about, I'll tell you, just about all these. Okay, and except for inventory, we'll keep an eye on inventory, but just about all these assets here and all these liabilities will be translated at the current rate. So this is, I'll give you the date here. This is a 1231 X4. That's the current rate. We'll use the rate at 1231 X4. And then for cash, accounts receivable, inventory, plant equipment. Okay, and so we're going to use accounts receivable, same rate, whatever the rate. It's going to be 58 cents. That's going to be this rate right here, 1231 X4. And we're going to use, and that's correct because, theoretically correct, because those are monetary assets and liabilities which are recorded at the current value, generally speaking. But we're also going to take items which you might record at historical value, inventory and plant and equipment, and we're going to also translate those at the current rate, receive those at the current rate, which is theoretically kind of inconsistent, but that's the method that the way the method is done. Keep it simple. Okay, then the allowance for doubtful accounts, we're going to use the same rate here. Use the same rate for allowance for doubtful accounts, accounts payable, notes payable. Okay, take that out of there. Okay, then we come to dividends. Now, dividends is an equity item, and for equity items, we're going to use the historic rate. Now, I did try to mention that we have a 49-cent historic rate when the company was purchased. However, that's not a historic rate. Historic rates, you have to look at when the transaction took place, when you bought something, or when you paid a dividend, whatever. So it says, number 3, your dividends were declared and paid on July 30th, 1984, when the exchange rate was 51 cents. So in a sense, we're going to use, this is going to be as of 730 X4. Our rate at 730 X4. And we're doing that because, in a sense, we're using the historic rate when the dividends were paid. In a sense, that's the historic rate. Okay. Now we're going to come down here to common stock and retained earnings. Keep in mind, little rule I gave you up here, way up here in the corner, equity items historical rate. Okay, so for equity items, you're going to use the rate that exists when, in essence, when you bought the company in this case. So we're going to use the rate at 1231 X3. So this is going to be 1231 X3. And then we'll also use that same rate here, 1231 X3. And then we just come down to, you'll see that everything else is an expense or revenue. Then we have our translation adjustment, which, by the way, is going to be the plug number here. Okay, so it's not really all that hard. So now we're going to use the current rate for sales and all these expenses. We're going to use the average current rate because we're assuming that they're incurred throughout the year. So we'll just use, I'll just say this is going to be the X4 average. So this is going to be average for X4. That same is going to be true for these items here, which will be 54 cents. Okay, so we know the rates now. Now we know that the rate at 1231 X4 is 58 cents. 58 cents, and we're going to use that rate across the board here. Let's go ahead and get this 58 cents over with for the other items, for the other liabilities. We got all the assets, now we've got all our liabilities here. Okay, then let's go down to, let's do the 51 cents. Now we're doing dividends because we're using the historic rate, and this is why remeasurement, the other method when you use historic rates, is so complicated. If you've bought 1,000 assets, you've got to refer to 1,000 different rates. That's why companies like this one. And so 51 cents was the rate when the dividends were paid, and then we're going to use the 49 cents for historic rate right there because you see my cursor when these the company was purchased. And then we're going to use the average current rate. We'll start here down here, sales for the year, which is 54 cents for sales because they're earned evenly throughout the year. And then we'll use the same rate for those right there. Okay, so let's go ahead. Now all you need to do is multiply these things out. And we'll see what we get on the asset side. Get your asset side first. Just multiply these things out. And we're going to sum these things up here, which we get 158,980. Like, looks good. Let's go ahead and multiply everything else down here. Okay, and what we can do just to get the translation adjustment, let's go ahead and total this thing is equal to sum of these things right here. Let's see if this works. Basically, your translation adjustment, and I'm just going to put here, is really the plug, which will be the same case for remeasurement, by the way. So this is the plug figure right there. Okay, so let's see if we can do this. I'm going to take 158,980 minus the sum of all these numbers here. I don't think I'm going to get circular reasoning here. I might. 58,980. So, okay, so this is your, I'm going to put this in bold. This is your translation adjustment, and it's going to go to OCI. Remember, the translation adjustment is cumulative, and it goes to OCI. I'm going to put the words cumulative here, C-U-M. Cumulative goes to OCI, and now all we've got to do is write up our financial statements as if we were doing accounting 201. Okay, it's just a regular thing here. Okay, let's get rid of all these things here. Okay, and see something here. I want to outline one number for here. I want to highlight this number here. Highlight that number. Okay, so let's go down, just get our sales. Our sales are equal to, it's like writing a financial statement accounting 201. 48,600 minus your cost of goods sold, which is 27,000. Your gross profit is 21,600. Is equal to minus your depreciation expense. Your depreciation expense is 4,320. Incurred throughout the year. Your other expenses are 5,400. Or let's call it your remeasurement loss is 0, and you wouldn't even have it on here. Okay, so I just adapted the other sheet. Would not be here. I'll leave it at 0, but you wouldn't even put it there because you're going to have the translation. Maybe it's a good thing because I'm going to say, forget that. What you would have is you would have your remeasurement loss. Your remeasurement loss under, this is not remeasurement, it's translation, so the adjustment is the translation adjustment. It's going to go on the balance sheet. Okay, so it would not be here. So remember, this is a translation, so you got 21,600 plus 4,320 equal to 21,600 plus 4,320 plus negative 5,400. So Your income is 11,880. Okay, now your beginning retained earnings are, and this is why I wanted to put this in there, make sure it's all there. Your retained earnings are 19,600 plus your net income of 1180. That's going to equal for, we'll just take out dividends. We could do a subtotal, but I usually do a subtotal with the email. So it's beginning retained earnings plus net income minus your dividends. Dividends are right up here, minus 5,100. Okay, so your ending retained earnings, your beginning retained earnings plus your net income minus your dividends is 26,380. Is your ending retained earnings. And as you remember for 201, obviously 26,380 goes there. And now we just go ahead and bring down all the assets. And since the trial balance, you know that balance sheet's going to balance too. So we'll bring down the cash, 23,200. Bring down the accounts receivable. Bring down the accounts receivable. Accounts receivable is 11,600. Let's go ahead and just move that over. We'll get the net realizable value of accounts receivable. So we'll do that equal negative whatever the allowance is up here, allowance for doubtful accounts, 1160. So the net realizable value of accounts receivable is 11,600 minus 1160 gives you 10,440. Then you've got inventory. Inventory is 24,360. Plant equipment is 58,000. Our total assets are equal to 116,000. And then we've just got 2 liabilities and 2 shareholders' equity items. Okay, it says 3 shareholders' equity items. Okay, so our common stock is 49,000. Oh, that's what it was. Now, bring our common stock out here as long as I did it. And common stock comes down here. Go back to our accounts payable and notes payable. Accounts payable, 10,440. Notes payable, 17,400. Common stock is 49. The cumulative translation adjustment is our big number here, 1270. That goes to OCI and real estate of financial statements. That's where you're going to find it. Okay, so our total assets anyway were 116,000, and our total shareholders' equity, liabilities and shareholders' equity is equal to the sum right here, and that should be, get that straight out. Okay, now a couple things. Number one, let's make sure we understand what we're doing. These were all expressed here in Australian dollars. These were Australian dollars. That's what the problem was written in. So these amounts here are, I'll just put Australian dollars. I don't know what I think they use dollar sign by the way. Okay, and so you restated them to US dollars. So all the numbers that you brought down from the adjusted trial balance down to these financial statements, these were all US dollars. So these are financial statements as of for 19X4 financial statements, and keep in mind that these are US dollars. So that's the point of this exercise: is you own a company in another country. In this case, you deem that translation would be appropriate because you're manufacturing in US. You own a company which is manufacturing, selling in another country. So then you use translation. Okay, and translation, the rates. You see me do it. Basically, current rates for everything. Average rate, current rate for all assets and liabilities. Average current rate for revenues and expenses. That makes sense. And historic rate for equity items. And now let's just go ahead and make sure, this will be very important, is let's change this, because even though we always assume that everything's in dollars, US dollars, I just want to make sure to emphasize that we have taken statements that were in Australian dollars. Those are right here. We stated them at the current rate direct rate for between the U.S. dollar and Australian dollar, and then we just once we got our plug, which is the translation adjustment. Translation adjustment goes down here, and we end up with U.S. dollar statements of bouncing out at 116,000. Now, the one thing to remember, the advantage of translation, cheap. It is cheap and simple. And it is simple. Look how simple it was. Doesn't matter what type of asset or liability it is. You use 58 cents, and then for equity items, you just a couple of rates. You look at the historic rates for equity items, and then you know what the current year's average rate is. So it's cheap and simple. Disadvantage. Non-monetary items are valued at using inconsistent. What do I mean by that? Well, let's take a look at plant and equipment. Plant and equipment, maybe you bought this plant and equipment a year ago. Plant and equipment is supposed to be valued at historic cost when you bought it, but you're taking the historic cost, which is 100,000, and you're restating it at the current exchange rate. So what does that mean? Nothing, other than that it's cheap and convenient. It really, that 58,000 doesn't mean anything. It's not your historic cost. It's not your fair market value because you're using historic cost. You're using the current rate. That's okay, but using historic cost. So this 58,000, it doesn't really mean anything. It's sort of a convenience. It's a way of conveniently translating. So it does keep the relationship between, if you calculated financial statement ratios, if you're using the same rate, it would keep that the same. But theoretically speaking, what is that value? It's 58,000. Well, it's not your historic cost because you're using the current exchange rate, not your current value necessarily because you're using your historic cost. So everybody knows that this is historically, theoretically unsound, but companies use it because the big thing, cheap and simple. And those aren't minor things in accounting. Anyway, I'm going to put this up and I'll put to the measurement sheet next.